In this lesson, we will be covering intercompany sale of inventory. So in the previous video, we went through a high-level overview of intercompany transactions. And in this video, we will deal with the specific journal entries relating to the intercompany sale of inventory. The intercompany sale of inventory will most likely have 3 journal entries. The first journal entry will relate to eliminating the intercompany sale and purchase. The second journal entry will relate to eliminating the unrealized profit included in the current year's closing inventory. And then the third journal entry will relate to re-performing the journal entry of last year, as well as realizing the unrealized profit of last year. So the third journal entry will only take place if there was an unrealized profit relating to the prior financial year. So let's get into the first journal entry, eliminating the intercompany sale. So let's say, for example, a subsidiary makes a sale of 1 million rand to the parent. So therefore, the subsidiary is making a sale and recognizes a profit, and the parent recognizes purchases or inventory. Now, this journal entry will have to be eliminated. Why? We are only interested in representing transactions with those outside of the group. So any intercompany transaction have to be eliminated. The journal entry to eliminate the intercompany sale is as follows: debit sales 1 million rand, credit cost of sales 1 million rand. The amount that we put through in the transaction or in the journal entry is the full sales amount for the entire year. So why do we debit sales? In the subsidiaries books, they have recognized a sales revenue of 1 million rand, and that means they have credited their sales figure. From a group perspective, we do not want that sale, and hence we need to eliminate it. The way we will eliminate or reduce the revenue figure is by debiting sales. On the credit side to cost of sales, why do we credit cost of sales? Recall the parent made a purchase. So in the parent's books, that 1 million rands worth of purchases is included in the parent's purchases figure. Purchases is included in the cost of sales figure. Remember the formula of cost of sales. Cost of sales equals opening inventory plus purchases minus closing inventory. So when the parent bought the inventory, purchases increased. Because purchases increased, that means cost of sales increased. So to reduce purchases, we'll be reducing cost of sales. Cost of sales reduces on the credit side, and therefore we are saying credit cost of sales. What you should note, that both transactions is going through profit or loss. Revenue is a P&L figure, cost of sales is a P&L figure, and hence by decreasing sales, you are decreasing profits by 1 million rand. By decreasing cost of sales, you are increasing profits by 1 million rand. So the impact on profits is 0. Therefore, there's no impact on deferred tax and there's no impact on NCI. So then why do we bother with putting through this journal entry? Once again, if you think back to the conceptual framework, we are providing users with financial information that is useful for decision making. If you read the conceptual framework in a little bit more detail, then you will understand that financial ratios plays a critical role for investment analysts and so forth. And the revenue line item is a significant number that many analysts and companies look at or review or analyze. And hence, we want this revenue figure to provide a true picture and not allow an opportunity for companies to inflate their revenue figure by just processing an intercompany sale. So that is kind of the reasons as to why we do this elimination. It is purely for disclosure purposes, and it's helping us achieve the objective of financial reporting. Now, let's go into the second journal entry. The second journal entry is to eliminate the unrealized profit that is included in closing inventory. Let's carry on from this example. We said, let's assume that the subsidiary made a sale of 1 million rand to the parent, and let's assume that of this 1 million rands worth of purchases that the parent acquired from the subsidiary, that there's only 100,000 rands worth of this inventory left over. So therefore, included in the parent's inventory is inventory worth 100,000 rand relating to an intercompany sale. Now, included in this 100,000 rands worth of inventory as a result of the intercompany sale, let's say there's an unrealized profit of 10,000 rand. So this profit is not a profit with someone outside of the group. This profit is still within the group because the inventory has not yet been sold to a third party. And as a result, from a group perspective, this 10,000 rand of unrealized profit may not be recognized. What you should note that when there's an intercompany transaction and the profit has not been made outside of the group, we call it an unrealized profit. If the transaction subsequently went to a third party, then we will call this profit a realized profit. So while the inventory is still included in the parent's inventory balance, the profit that the subsidiary made on the parent is considered unrealized, and hence we need to eliminate this profit. Consequently, the inventory balance of the parent is overstated by 10,000 rand from a group perspective. So the journal entry would be to eliminate, to reduce the unrealized profit, to reduce the inventory balance. So to reduce inventory is an asset. So we said inventory is an asset. We want to reduce inventory, and therefore we have to reduce an asset. Assets decreases on the credit side. So we will be saying credit inventory 10,000 rand. For every credit, there have to be a debit. The debit between inventory is usually cost of sales. So we'll be debiting cost of sales 10,000 rand. So we understand why we are crediting inventory, because we want to reduce inventory, and inventory is an asset, and asset reduces on the credit side. Let's understand the debit to cost of sales. Recall what we are trying to achieve. We're trying to reduce the group profits with this unrealized profit of 10,000 rand. So by debiting cost of sales, we are increasing cost of sales. By increasing cost of sales, we are decreasing profits, and hence we are achieving what we want to achieve, to reduce group profits. Take note that cost of sales is a P&L figure, whereas inventory is a statement of financial position figure. And therefore, because one is going through profit and loss and one part of the journal entry is going through the balance sheet, there is an impact on profits. The impact is a decrease in profits. As a result, there will be a deferred tax implication. So what is the deferred tax journal entry? It would be as follows. Because profits is reducing, we expect income tax to reduce. We reduce income tax by saying credit income tax, P&L. The other side of the journal entry would be to defer tax, so therefore the other side would be debit deferred tax, SFP. The amount we will place on this income tax would simply be 28% on 10,000 rand, which would be 2,800 rand. The next question you want to ask yourself is there an impact on NCI? Recall, based on the overview video on intercompany transactions, we said for NCI to be impacted, two conditions need to be satisfied. Number one, there must be a change in profits. So we already seen there's been a change in profits. But number two must also be satisfied, and that is the transaction must have taken place in the subsidiary. It must be the subsidiary that made the profit. And since the subsidiary made the sale to the parent, the subsidiary is making the profit. The subsidiary, the transaction is taking place or has taken place in the subsidiary, and hence NCI will be impacted and will have to process an NCI transaction. So because group profits went down, that implies that NCI share will also go down. NCI is an equity balance. Equity reduces on the debit side. So therefore we will say debit NCI equity, and we will credit profit and loss, and we generally will just call it credit NCI P&L. With what amount? We will adjust the NCI balance by the after-tax figure, that is 10,000 Rand minus 2,800 Rand, which is 7,200 Rand, but we won't reduce equity NCI by 7,200 Rand, we will reduce NCI by their percentage of the 7,200 Rand. So let's say NCI is 30%, we would say 30% times 7,200 Rand. So that is the second journal. Now we come to the third journal. The third journal relates to the prior year's unrealized profits. So we only have this third journal if the subsidiary or the parent, if there was an intercompany sale relating to inventory in the prior year. Before we get into this journal entry, you need to understand something, that one of the assumptions is, one of the rules for pro forma journal entries is that pro forma journal entries are reproduced from scratch every single year. So every journal entry that you have processed from the time of acquisition, from the acquisition date time up until now, needs to be reproduced every single year. So every single year you will reproduce at acquisition journal entries, you will reproduce since acquisition entries, and you will reproduce last year's current year entries. So let's understand how this journal entry would take place. Last year, if there was an unrealized profit last year, the journal entries last year would have been debit cost of sales, credit inventory. It's the same journal entry as we have this year. So that is last year's journal entry. You need to reproduce last year's journal entry this year. So how do you reproduce it? You will still say credit inventory with whatever amount, and you'd like to debit cost of sales. But the reason you can't debit cost of sales, this cost of sales relates to last year. Last year's cost of sales is no longer there. Last year's cost of sales have been closed off to profit or loss, and profit or loss have been closed off to retained earnings. Hence, instead of calling this line item cost of sales, we will have to call it retained earnings. So the journal entry is debit retained earnings, credit inventory, and this relates to last year's journal entry. Now there's a second journal entry that needs to be processed. The second journal entry is realizing the profit of last year. So you are realizing last year's unrealized profit. And why is that the case? Last year's closing balance have become this year's opening balance. We assume that all opening inventory have been sold to third parties. As a result, because it have been sold to third parties, we now have to realize the profit. By realizing the profit, the journal entry would be as follows. We would credit cost of sales. Why? We are reducing cost of sales. By reducing cost of sales, we are increasing profit. That's what we want to do. The other side of the journal entry would simply be a debit to inventory. So take note, there are two sets of journal entries if you have a prior year unrealized profit transaction to do. Number one, it is to reproduce last year's journal. And number two is to realize the profit you have recognized as an unrealized profit last year. So the first one, debit retained earnings, credit inventory. The second journal entry to realize the profit is to say debit inventory, credit cost of sales. Now, as you would see, if you look at the two journals carefully, you'd see the one has credit inventory and the other one has debit inventory. So basically the two inventory balances net off. So you're ultimately left with one journal entry, which is debit retained earnings, equity, credit cost of sales, P&L. So the question you may ask, what if the inventory is not actually sold? So that is why we assume that it is sold, because even if it is not actually sold, we will capture it in the current year's closing inventory. And that is the reason why we have to do the second journal entry. If we don't do the second journal entry, we may be double counting the unrealized profit, and that means we would never ever be recognizing the ultimate profit that would ultimately be made. So just keep that in mind. Once again, you need to think about the impact on deferred tax. Because profits are impacted, we will have an impact on deferred tax. And another thing you need to take note of is if there's an impact on NCI, and because the transaction took place in the subsidiary, there will be an impact on NCI. So to recap, there are three journal entries or three sets of journal entries that impacts the intercompany sale of inventory. Number one, it is the elimination of the intercompany sale. Number two, it is the elimination of the unrealized profit included in the current year's closing inventory. And then number three, it is to recognize the two journal entries that make up last year's closing inventory. When you read a question, they will refer to it as opening inventory. Okay, so basically there's three journal entries: elimination of intercompany sale, elimination of unrealized profits included in the current year's closing inventory, and then the journal entries relating to opening inventory or last year's closing inventory. Once again, thank you for watching. Until next time.